Hello traders, Gary Wagner here. Just after 1 o'clock in Honolulu, 6 o'clock in New York. It is Friday, happy Aloha Friday as we say on the islands. 20th day of December, 2019, and this is the daily report for gold and silver, our weekend review. And this week has been quite interesting because there really wasn't a lack of fundamental events, either geopolitical or political. And as such, we saw gold move very, very little when we take a look at the open and closing ranges. We had, with the exception of Thursday, 4 days of what candlestick technicians call a doji. And that is a price day in which the open and close are either equal or just a couple ticks apart. The other thing that was noteworthy is that on Thursday, we actually closed above the 50-day moving average for the first time, I believe, since June or July. On today's report, I want to continue to look at the compression triangle, which is the flag and pennant formation. And I also want to revisit our long-term monthly chart and Elliott wave as we get close to next week's release of Outlook 2020. Let's take a look at current pricing. For those of you that either follow or are Elliott wave practitioners, you realize the fractal nature of a wave count. And that is to say that you can take any of the particular waves and then subdivide them into a count below that. So for example, this is a super cycle third wave, a major wave going from 270 to 1920. But within that, what you can certainly do is you can find a way to do a count that will take you to a 1, a 2, a 3, a 4, and a 5 within that. Now, within each of these, for example, the impulse waves, you can then further reduce them on a fractal nature. So this is an extremely big picture. And when we look at it, we are looking to forecast out multiple years, not multiple months. And what this is showing us is extremely exciting because by nature of this being labeled as a major or supercycle third wave, what that tells us is that there's going to be a fifth wave that should be either equal to wave 1 or an extension of wave 3 by 0.618, and that is precisely what we plotted right here. So we have this large third wave. Following that, we get a fourth wave correction, and this fourth wave correction takes us just below the 50% of the entire move. You can see that in red here. And then from there, it is the assumption of myself that we started a fifth wave impulse count. Now, the beautiful thing about that is both the Elliott wave get, which is this small 5 in blue, as well as my handwork to create an extension of 0.618, they come up to virtually the same price point, which is 2073. And I believe that that is where we will see gold go to over the next 3 years. Sometimes it is very difficult to get excited about a market that tends to be moving in a narrow range, sideways with not much action. But I'm going to try to change that for you today by looking at a couple of studies. First, the bull and pennant formation, and secondly, a long-term view. In terms of the marketplace itself, interesting facet is even though gold closed off by $2, when we look at our 50-day moving average, that is this green line here, we can see now for the second day in a row, we actually closed above it. And that gives us some bullish hope nonetheless. Now, the next market is going to be platinum. That closed down 2.5%. 911.80. Palladium really dropped hard, almost $80 at $1,822.30. And finally, the Lone Star Silver closed up 11 cents at $17.26, and that's all within some strong headwinds of a dollar strength day at 97.28 in terms of closing price. Let's take a look at our charts. We are looking at a daily candlestick chart. This of continuous contract of gold, and I'm trying to differentiate, as we have been talking about over the last couple of days, very similar formations, one being called a bull pennant and a bull flag. There's also the bearish version of them, and Whether it's bullish or bearish depends really on the pole, because if the pole is moving to higher ground, that means that the prevalent trend direction has been up. We can certainly make a case for that. Obviously, the reciprocal and reverse is true for a bearish formation. Now, here's the key distinction. When we look at what is called a flag formation, it kind of looks like a flag. In other words, you basically have parallel lines that are coming in, forming a range, and it looks very much like a flag. As you can see on the upper left-hand side of the screen, I have just put up a textbook case or an example of what a bullish flag formation would look like. This is from Profit.com, and what you can see is that it basically talks about the same thing that we have been, which is you start with your flag pole. You basically have a parallel market that is moving asymmetrically to the downside, and then at really the apex or the end of that, you get that solid breakout to the upside. Now, we certainly did not get that in this case. In fact, what happened is this particular pattern, the bullish flag formation, morphed into a bullish pennant, because the difference between the flag and the pennant is that on a pennant you have an asymmetrical triangle, which can be defined by a series of lower highs and a series of higher lows. And in essence, what you're waiting to do is look for the energy to build as the price range compresses. When it hits the apex, it will release the energy. And traders, you can see that on the upper left-hand side of the screen, I have changed our textbook example to the bull pennant, and you can see exactly how you get that asymmetrical triangle, you get a compressing of range, and what we're looking for is a solid move up for the market to basically trade through a series of sideways trading waves causing a narrowing range until it hits the apex and then breaks to the upside. And that's truly what we're looking at now, and I believe that we will see that unfold sometime towards the beginning of next week. Currently, my recommendation is to maintain your current neutral stance. I will talk to you on Monday for the next daily update and review. Bye-bye.